Hi everyone, this is Baldwin 2 from Industry 479, and this is our final analysis. So our mission is to create reliable premium products for everyday customers and create products that have fresh and exciting designs that are easily accessible and that have improved size and performance. So our overall strategy is to transition all of our products to the traditional low-end and high-end segments. We would be moving our size and performance to traditional, moving our traditional to low end, and then introducing a new high end product. Just we have two products per segment. We would also have higher prices than our competitors, but because we have high quality products that match customer buying criteria, that would make up for it. And we would also have very aggressive spending in marketing. So for year one, um, we had poor performance in our traditional and low end just because our age was not ideal. We had a lower market share than expected in traditional because of this, but we did have a high market share in the low end just because of our good positioning. We did well in high end because of our high MTBF, and we had a lower price compared to our competitors. We also repositioned our performance and size just slightly just to maximize our profits before exiting the performance and size segments. For marketing, we kept our promo and sales budgets to a minimum just to prioritize positioning and R&D. We decreased the prices of Baker, Bead, Bid, Bold, and Buddy, which are all our products, um, just to increase demand, and specifically for Bold and Buddy, our size and performance products, to get closer to the traditional segment prices. For production, we stocked out on low end, and we also had very high expectations for Baker, our traditional product, just because of how well that did in our practice round. So we bought a lot of capacity, but we ended up producing a lot more than we sold, which led us to take out an emergency loan. But other than that, we had investments in TQM, which helped with increasing our demand and reducing our R&D cycle times. For year two, Bold and Buddy, our performance and size products, transitioned to traditional, but their revision dates were at the end of the year. Our high-end product was a strong competitor, but had late revision dates, so we had lower sales than our competitors. Bead was well positioned, that's our low-end product, and had a high market share despite having low age. For marketing, we also kept our promo and sales budget minimal to prioritize positioning and R&D. We did not change the prices for Baker, but we did increase the prices of Bead, Bid, Bold, and Buddy because we realized that we decreased them a little too much in the previous round, and we wanted to maximize revenue. Uh, for production, we stocked out on both traditional and low end because we didn't position the product soon enough, and we also had a high inventory for our size and performance from the previous round. But other than that, our finances look good.
In year three, this is an important transitioning year for Baldwin. We're positioning Bold and Body more and more to the ideal spots. We got stock outs on traditional and low-end markets because of not enough production. We have all the products at the greatest reliability according to segments, which gave us a competitive advantage of giving the most reliable products. We did not did that well on the high ends because our highest products released later than others, which results in less sales. In marketing, we get really high promo sales budget because Bold and Body are almost fully transitioned from performance and size market to traditional segments. So we got around 2,000 for Bold and Body and only 1,000 for others. In production, we still have sales on size and performance market because our overproduction in the previous rounds. Also, we did not buy a lot of capacities on this round because the expectations on transition is not that high for us. And in the financial situation, we did pretty good overall. Zero emergency loan, 1 point leverage ratios. Yeah. In year four, we got fully transitioned from both embodied to traditional. Introduced new high-end products. Boss was invented and does not release until May of next year. And marketing, we only have minimal promo and sales budget, a lot for introduction of Boss. We got standard promo and sales budget for all the segments to maintain awareness and accessibility. In addition, we decreases price on every product in order to get a higher demand. compared to our competitors. In production, we have only expected really high potential production on traditional market. It reached 60% of the potential market share. However, this actually result in not enough capacity. Starting this round, our plant utilizations for a lot of product excess 150%. In finance, this is our first time to pay dividends and it's higher than our goals. Also, we have better cash position now, which allows us to do earlier retirements of bonds.
In year 5 for R&D, we position all products in high-end and traditional to be at an ideal position in size. We made no changes in low-end, so bead can reach an ideal age, despite it being phasing out in position and size, and Baker to reach an ideal age as well. Overall, our revision dates were mid-year or sooner for this round. For marketing, we prioritized the high-end segment because Bounce was just released, and for pricing, we decreased Baker and kept Bead the same because Bead was at an ideal age of 7.1, and Baker needed to catch up to ideal positioning as well. We also kept Bid the same price to maximize revenue and decreased Bold and Buddy only slightly to match demand. For production, we stocked out in traditional and low. This was because of our high volume of TQM investments increasing demand, but our capacity and production levels could not keep up, forcing us to perform excessive plant utilization as shown by the chart below. For finance, we paid $1 dividends, which was higher than our goal of 50 cents. And we focused on TQM investments primarily on reducing costs in material and labor, which drastically increased our contribution margin and profits. And we also did some early retirement of bonds, which was also higher than our expected goal. And in year 6 for R&D, we performed similar R&D changes to year 5. Only thing we took note is Bead is phasing out. So in the future, despite the competition ending, we would position Bead back into the low end circle. Overall, we ensured revision dates were no later than July to marinate profits and attract early sales. For marketing, we prioritized the low end segment because we wanted to keep Bead as profitable as possible despite aging positioning. And there were other priorities in earlier rounds like Bold and Buddy with the segment shift in year 3 and Bid and Bounce with the new product Bounce in year 5. And for pricing, we decreased Baker and Bead to keep up with low end price range. And we also decreased Bid and Bounce to increase demand as we noticed the only distinct factor in high end was the price since other data was similar to competitors. But overall, we achieved our goal of at least 80% awareness and 55% accessibility for each product. For production, we had sustainable development, increasing automation rate for Bounce to 3, which was originally at 1 because Bid's automation rate was also at 3, so we wanted to match those levels. And for capacity and demand, our plant utilization was still kind of concerningly high, but we started to kind of reduce that plant utilization as we kind of kept buying more capacity as we will in the future. Yeah, for finance, we saw that our leverage ratio was a little bit concerning because of our debts reducing, and we had a high dividend pay of 150, which increased a lot of our stock price. But overall, we accomplished our R&D goals, marketing goals, production goals, and most of our financial goals.
Regarding our income statement, we first see concerning sales and growth rate for year 1 and year 2 because we are still in the process of repositioning our products. Starting from year 3, we get higher sales and growth rates. For depreciation, our depreciation increases annually because we do plan investments every year to make sure we have the enough capacity to meet the demand. For SG&A cost, it is high in year 2 and 4 because year 2 is the most important year of our reposition plan, and we spend a lot in R&D investment. And year 4 is the time we introduce our new product. Regarding promotion sales, since our vision is to make sure our customers can easily access our product, we need higher promotion sales budget. Coming to balance sheet, notice the highlight to AR. We originally have the plan to increase our AR lag days to increase demand. However, it turns out that our high volume business structure doesn't allow us for doing this. We can let our customers retain the most cash. That's why we end the plan and make no change to AR lag days. We also have high plant and equipment value because our capacity is high due to high demand. Then So is our depreciation, which links with plant and equipment value. For long-term debt, we aim for lower, and we do achieve it. It is because since year 3, we have better cash position, which allow us to do early retirements of bonds.
In regards to our competitors, we thought that our main competitors were Digby and Ferris based on the target segments that they focused on. Mainly for Digby, it was all the market segments, and for Ferris, it was the high end, which we also primarily focused on as well. And we kind of just compared profitability and market shares, noticing that we're growing in profitability and we're kind of neck and neck with market share with Digby. And then we also just listed our contribution margins and strengths and weaknesses, also noting that our contribution margin is very low compared to our competitors, ensuring that we need to reduce material and labor costs. And we also noticed some high-end threats based on these two competitors, with Ferris and Digby introducing high-end products in year 2 and year 3, which allowed them to have like an advantage of increasing accessibility and awareness from years 3 to 6. And also we just had a lot of drawbacks within our own internal business factors, with slightly later revision dates, which delayed sales, and stockouts, which caused Digby and some of Ferris to pick up our missed sales. And then in the bottom right, you can see just like a kind of map of quality versus price in regards to our products based on a segment. So for high end, you can see that Digby, Ferris, and us are very neck and neck with quality. The only thing is we just have a lower price. And for traditional, you see that Digby and us have the same quality but a higher price. And for low end, you can see that we have the lowest quality and almost the lowest price to account for the matching low-end buying criteria.
Regarding scenarios and sensitivities, there are 2 meaningful scenarios. The first one is that we actually achieve our best case scenario with more than 20% annual growth in sales starting from year 3, especially our year 3 growth rates reaches to be higher than 60%. The number one result is that we have the highest market share. In the end of year 6, we have 32.48% of the market share, and we have more profits than expected. The reason is our strategy to perform aggressive marketing plan and TQN investments. They really help in raising demands and hence the profit. We also secure our dominant position in trad and low segment. The second one is the consistently low contribution margins. As the graph shows, we experience the lowest margin in year 4 as 22.5%, which is significantly lower than our competitors. The number one result is that we failed to convert a huge amount of sales into profits, and our costs are too high. The underlying reason is our frequent reposition to products, especially for the traditional products. And also our high volume production drives the cost up. To alleviate the situation, we explore in TQN investments to reduce both material and labor cost.
For learnings, we basically divided in 4 parts. Firstly, it is important to decide strategy, set goals, and determine roles early on so everyone knows what they are doing wrong by wrong, and adjust strategy based on unprecedented challenges. Pay attention to what competitors are doing. Secondly, we need to go full force with our strategy. In Capstone, we did not transition our products from segments to segments fast enough. This is important. Like, we need to follow all the details with our strategy. Take the jump when making decisions. It will likely be more efficient in the long run. For HR, we did not look at this until round 5, but since this is a long-term investment, we did not put an investment on HR. This is a warning that we need to pay attention to both investments like HR and TQM with production. They're equally important for the development. Overall, look at the big picture always benefits the industry.
In terms of the interaction, we found it really helpful that we created a 5-year plan and decided goals early on just so we had a clear idea of what each person was going to do for each round. Communication-wise, we did pretty good on that by sending frequent updates to our group chat. We also held Zoom meetings for each round to share our concerns or resolve any issues we had. Overall, we really enjoyed our Capstone experience.